So today I'm going to continue where I stop off on my first talk about valuation, and we will dive deeper into business valuation from startup to IPO, part 2. Now allow me to share my screen. Let me check. All right, so we're going to talk about understanding valuation. Now, it's very important for us as investors to understand a business valuation before we decide to part away with our hard-earned money into a business that we're going to invest. Now, many of times, investors want a quick exit. Now, if you are a type of investors, we call it impatient investors. Sorry to use that word, but there's two types of investors in the market. One is patient investors and one is impatient investors. Now, the connotation doesn't give you a negative sense, but investors who generally want a quick exit, probably in a year or 2 years, and they want liquidity, then investing into private equity, it is not something that you should look forward. Perhaps you should go into fixed deposit or maybe into the stock market. So why do I start by saying this? It is because when we as investors understand that a business needs 3 to 5 years to grow before it can exit. So therefore, we have to understand that it evolves with patient investors, we call it, or we call it as patient capital. So being investors that understands what is patient capital and what is the exit strategy. So therefore, it is very important for us to understand valuation. So why do we value a business? We value a business, it is because we want to know what value does that business has before we make a decision to invest in it. And whether such valuation is what we call that on par with market rate, or is it above market rate, or it is below market rate. So in the past, I talk about 5 things in private equity. First, the very common one is actually venture capital. Then we talk about leverage financing. Then we talk about mezzanine capital. Then we talk about growth capital, and then we talk about startup capital. So all these 5 things that I've shared in the past comes back to one thing, which is valuation. So we are ready to invest into a business. It is because we want that investment to make sense, and that investment will actually give us our retirement money, or that money that we earn will give us into our next venture. So there are a number of ways to determine the market value of a business valuation. Now let us examine it. A very traditional approach is actually we actually value a business based on the value of the assets. Now that is very straightforward, all right? We take the entire asset of the company. The first asset of the company is always cash. How much cash in hand does the company has? That's number 1. And number 2 is PPE. PPE stands for plant and equipment. So it's actually plant, property, and equipment. So PPE. So we take the cash on hand, we add up with the PPE, and then we will get the total value assets of the company. But we have not come to the net asset yet. So we also have to look at the debt of the company. How much debt the company is in with a bank, or maybe with private investors, or maybe the claims of the directors which they have advanced. And then we also take up the liabilities of the companies. Like for example, we order stocks. So if you are in the business of, let's say, selling equipment or selling groceries, so you definitely have to order stocks. And most of the time, they will give you 30 days credit. So you take the liabilities of the company, you add up all together, and then you subtract it you minus it from the total assets. And the total assets also include the inventory on hand as well. Because when you buy an inventory, there's a cost and there's a selling price. So you have to minus off that particular margin. That will be your, what we call that, your total value of the assets. Or if you have paid up your inventory, then the entire inventory belongs to you. So it's actually asset on hand, which can be turned into cash. So the value of the business can be determined by, first and foremost, the value of the net asset of the company. So let me read from here. The value of the business balance sheet is a least starting point for determining the business worth. But the business is probably worth a lot more than its net assets. How much revenue and earnings can you expect? Let me share with you my experience yesterday. Yesterday, we have listed Jocom, one of our portfolio, in one exchange, Singapore, which is also the third board in Singapore. Although it is a private listings, but it is still a third board in Singapore, and it is still a listing process. So based on the valuation of Jocom, they are now worth about 110 over million before discount. And after discount, they are worth 80 over million. So do we say that Jocom asset is actually worth 80 over million after discount? No, but that is the valuation of that company. So when we value the assets of the company is probably worth a lot more than its net assets. All right. So, but having that kind of valuation, for example, in the case of Jocom, 80 million, or in the case of Danai Spa, Danai Wellness, which is right now 90 million. How much revenue and earning can we expect from here? As the business valuation goes higher, we'll definitely expect more revenue and definitely we expect more earnings. But what are the terms that we can use when a business is probably worth a lot more than its net assets? What do we call it? That brings us to the next slide. Now, if you look at based on revenue, for a lot of growing company, it is good that we actually talk about revenue before we talk about profit. I'm one of the person, I for one like to use the ratio called PS ratio or price to sale ratio. Now, many of times in the market, we use PE ratio, all right? But price to sale ratio is something that we commonly use. It is based on revenue and how much does the business generate in annual sales. We calculate that and determine through a stockbroker or the business broker how much a typical business in the industry will be worth for a certain level of sales. So price to sale ratio is actually based on sales revenue, all right? So the price to sales ratio is a key analysis and valuation tool for investors and analysts. And the ratio shows how much investors are willing to pay per dollar of sales, which means for every dollar of the sales, how much are you willing to pay to acquire the company or to invest in the company? And like all ratios, the PS ratio is most relevant when used to compare companies in the same sectors. So when we use PS ratio, we have to use it apple to apple, like AirAsia. You can't compare AirAsia with Malaysian airline. Why do we say that? It is because AirAsia is actually a budget airline. And Malaysian airline is actually a premium airline. So although both are in the same industry, but you can't compare that because one is budget and one is premium. So who do you compare with? Maybe you compare AirAsia with Jetstar. Yes, AirAsia with Jetstar, or maybe Virgin Airline, because all three of these is actually or are actually what we call it budget airline. So a low ratio may indicate that the stock is undervalued, while ratio that is significantly above the average may suggest overvaluation. So how do we calculate the formulas of price to sale ratio? Let us move to the next slide. So based on this formula, you can even Google price to sales ratio is equal to market price per share divided by sales value per share. So if the company is a listed company, you definitely have a market price. And then the sales value per share is actually you take the entire total sales revenue, you divide it by the total issued outstanding shares. So then you divide it from market price per share. Or you can take the total market cap. That means you take the total shares of the company, multiply by the, what we call it, the share price of that company, and then divide it by the total sales. And then you get the price to sales ratio. So for example, if the company market cap is actually 80 million, okay, I'm just taking my calculator, all right? Let's say, for example, if the capitalization is 80 million. So 80 million, you divide by the total sales, let's say 50 million per year, all right? 50 million. So the company price to sales ratio is 5.3 times. So that's what we call it, price to sales ratio. So you take the market cap, you divide it by the total sales. So that's the easiest formula that we in the market will always use. Because the first formula, market price per share, you need to do some what we call calculation, especially for companies who are not listed, right? And then you have to take valuation, you have to do a discounted cash flow on the valuation, and then you apply a 25 to 30% discount, and then you divide it by the sales value per share. How to get sales value is actually you take the total sales divided by the total outstanding shares. So it's a bit of financial mathematical calculation. But the other one, market cap divided by total sales, that is very straightforward, all right? So let us move into the next slides. Now, just now I mentioned about our price to sale ratio. And before I move back to the next slide, let me give you a hint. In the market, the rule of thumb, generally anything between 0.8 to 1.2 of PS ratio is a good ratio. All right. So I repeat, anything between 0.8 to 1.2 is a good price to sales ratio. It means that you are paying 0.8 over $1 of sale, or you are paying 1.2 times over $1 of sales to acquire the company. So for example, if the valuation of the company is actually 10 million or maybe probably 20 million, all right? So you want to determine what are the real PS ratio that you should apply to buy over or invest in the company. So probably you take 1.2, all right? So 1.2 times, all right? So what you do is you take the sales, you multiply by 1.2 times. So sales multiplied by 1.2 times is equal back to your market capitalization. You just flip the formula the other way. So you take the total sales, you multiply by, let's say 1.2, you get the total market cap. And then from there, you decide, okay, I'm going to apply 1.0 or 1.2 or 0.8, and I'm going to offer you, for example, I'm going to invest in the company for 10%. So from that market capitalization, let's say, for example, the market cap or the valuation of the company is 50 million, so 10% is 5 million. And henceforth, I will decide to, if you accept my PS ratio of 1.2, I will decide to invest 5 million for 10% of the share in your company. And that is how PS ratio is being applied. All right? So the other ratio is actually PE. Now, everybody is very excited when it comes to PE ratio. Now, PE ratio, allow me to read from the slides. We use earnings multiples. Earning multiple means 5 years of earnings. That is why it's called multiples, right? So first year, year 1, year 2, year 3, year 4, year 5. So we use earnings multiple. And the more relevant measure is probably a multiple of the company's earnings, or we call it the price to earnings or PE ratio. We can estimate the earnings of the company for the next few years, and a typical PE ratio is, let's say, for example, 15, and the projected earnings are 200,000 a year, then the business will be worth 3 million. So let's say, for example, year 1, your profit after tax is 200,000, and you multiply by 15, and then you get 3 million. So that's how much the business is worth. Or you are in the cash burning industry, for example, like Grab, all right? They can't use profit after tax because they are still not profitable. So, or in the case of Amazon, when Amazon were listed in NASDAQ, they were using EBITDA, earning before interest, tax, depreciation, and amortization, EBITDA. So certain industry, especially in the e-commerce industry, they have to use EBITDA, not profit after tax, to calculate their what we call worth, the business worth or the business valuation of the company. All right. So there's no wrong or right. So if you are in a traditional business, you have to use profit after tax. But if you are in the e-commerce business or electronic business or ICT business, software development business, then you will need to use EBITDA, because EBITDA is actually the true cash flow of the company. Because EBITDA will add in back the interest, it will add in back the what we call that, the tax, interest, tax, depreciation. So you add all these things back and amortization. So then you will get EBITDA. So that's the true cash flow. You decide how to use that cash flow and what to pay. And that is why we use EBITDA. So depreciation is actually we have paid the cost in advance. We have paid up the cash in advance, but we do not recognize it one shot. We depreciate it over years. And when we depreciate it over years, what happened then? If we depreciate it over years, then it means that is cash flow. Although it impacts your profit and loss account, but that is a true cash flow, and that is depreciation. And tax is something that probably you can pay in installment. Interest is something that probably you can pay in installment, and that is why it is true cash flow. And hence, you use profit after tax or you use EBITDA to multiply by the PE ratio, and then you get the business valuation of the company. And when we do a discounted cash flow analysis to derive to a PE, now we need to apply a DCF or discounted cash flow. Then only we can arrive to a PE. The discounted cash flow analysis is a complex formula. It's not easy. It takes me years to learn that, right? That looks at the business annual cash flow and project it into the future, and then discount the value of the future cash flow to today. So how much does the business worth in 5 years' time is we have to backward it and calculate how much does it really worth today. Like for example, the fixed deposit rate could be 2% at the current market rate. If you put in 10,000 ringgit, 2% next year, you get 200 ringgit. Am I right? But however, it doesn't mean that today's value is 10,200 ringgit. What is the today value of 2% fixed deposit rate that you're going to earn next year of today? So today you predict that next year, the same date as today, you're going to earn 10,200 ringgit because the fixed deposit rate is 2%. But what is the actual rate? What is the actual, what we call it, discounted rate of the FD rate of today? So you have to work it backward. And probably the actual rate is actually 10,000, not 10,200, but probably 10,020 ringgit. The moment you put in the money, you definitely have some interest accruing, but it is not 200 in totality. So the interest accruing is something that we have to calculate back to today. In very layman term, I shouldn't say this, it is not the right formula, but in very layman term, you can take 200 ringgit divided by 365 days and divided by the number of days that you want to cash out. So probably you get the true, what we call it, the true ratio of the FD rate as of today. So then the discounted cash, as I said, the discounted cash flow is a complex formula that looks at the business annual cash flow and project it into the future and discount the value of the future cash flow to today using a net present value. So we use NPV. Now we do not use terminal value. Why? Because terminal value, once it's reached to the particular year that we ended, let's say we project 5 years, we project 5 years of discounted cash flow. Once it reached the 5th years and we move into the 6 years, the terminal value has no more value. So that is why we do not use terminal value, because terminal value has a cutoff point of cutoff. But whereas a net present value, NPV, is actually a future value, but discounted to today. That is why it's called net, net, clean, present value of today. And how do we calculate a P ratio? And what valuation technique do we use? So there's 2 techniques. One is discounted cash flow approach, income approach, and one more is comparable company approach, market approach. Now, let us examine into the next slide. So let me grab a little bit of water. Now, when we do comparable company approach, market approach, we will look at 8 companies, 6 to 8 companies that is almost identical to the business that this company is doing. So in this case, you can look at the trailing over here. The trailing PE is actually the PE currently this company is trading in the stock exchange. It could be in China, it could be Malaysia, or it could be in Singapore, or it could be in Japan. But however, when you use a market approach, it has to be a regional approach. That's more accurate. You can't compare the same company to a European company or maybe to a US company because the approach is just too wide. You are casting the net too wide. So it has to be regional. So So therefore, when we look at these companies that is identical to the company that we are valuing, we will look at the trailing PE, which means the PE that they are currently trading. And then we will have to apply a certain technique to look at the 1 year forward PE and second year forward PE. How do we get that? It's also not simple, but I'm trying to make it simple for you to understand. All right. So normally we will look at these companies' projected profit after tax. And when we look at the projected profit after tax of the company, we will apply to certain techniques to arrive to a 1 year forward PE ratio. And then we look at the second year, the next 2 years, that's what I'm trying to say, the next 2 years of the profit after tax. Then after that, we take the PAT and apply a certain techniques, and then we will get the PE ratio of that particular companies. So then we add up everything together, we subtract. Let's say you've got 8 companies that you are valuing, you add up all the 8 PE together, and then you divide it by 8. And then you will get the average PE for trailing current year, first year forward, and second year forward. That's how we get the average PE ratio. And we multiply with the projected enterprise value, which is PS ratio, or EBITDA, or profit after tax. Now, as you can see over here, the projected revenue is 60 million, 57 million, and 151 million for the next 3 years. So therefore, and we have the EBITDA, which is 2.5 million, 8.2 million, and 26.4 million. So therefore, you can actually do 2 types. You can actually take EV, which is actually an enterprise value, which is actually PS ratio, or you can take the P ratio, all right? Or in this case, we can apply it to EBITDA, because this particular slides which I'm showing to you is an e-commerce company, and that's why we use EBITDA. So 1.34, 1.20, 1.12 is actually the PS ratio, or the enterprise value over revenue. So we are using an enterprise value over revenue, which is actually a PS ratio. We multiply 1.34 multiplied by 16.2 million, 1.2 multiplied by 57 million, and then 1.12 multiplied by 151 million, and therefore we get the predicted value 21.7 million, 68.6 million, and 169.4 million. These are the predicted value of the PS ratio, all right? And then, of course, we can use the P ratio. We can use the P, 19, 14, 13, multiplied by the EBITDA, and then we arrive at the P ratio valuation of the company. And later on, what we do is we have to take 21. We have to take 21 plus with 68 plus with 169. We will get a total figure, and then we have to divide it by 3. And therefore, we come up with the average value of the company for 3 years. Similarly, we take 50 million, 170 million, and 349 million. We add up together, we divide it by 3, and then we will get the average value of the company for the next 3 years. So one formula is actually the PS ratio formula based on revenue. Another formula is actually based on the EBITDA formula, which is earning before interest, tax, depreciation, and amortization. Then you ask me, Chris, now we have 2 formulas. We have the PS ratio formula, and then we got the EBITDA formula. Which one do I use before I decide to invest in the company? So then the next formula will be, which is the last formula, you take the revenue, EV over revenue value, all right, which is the PS ratio, and then you take the P ratio, you add both of these together. You got one is actually at the lower end, one is actually at the higher end. As you can see, 21 million to 169 million, when you add up and divide by 3 is at the lower end value. And then 50 plus 170 plus 349 is actually at the higher end value. So you add up this lower end and higher end value together, you divide it by 2, you will get the average. It means you have the best of both worlds. Now, by then, you have the best of both worlds, both revenue PS ratio and both P ratio, and that is how we derive to a valuation of a company. Sounds a little bit tricky and sounds a little bit complicated. As I mentioned earlier on when I started, business valuation is a complicated business. And that is why many of times business owner wants a good discount. Business owner wants wants a valuer like us to apply, to give them a good discount to get a valuation report. It's not that we can't do that. It is because the whole process is so complex. All right. So that is why that is how business valuation is done. Now, this one is actually another company which we use P ratio using PAT. So over here, the trailing P value for year 1, year 2, trailing year 1 and year 2, we have calculated it, and then we apply with the what we call net income, and that's how we derive with the valuation for the next 3 years. The same thing, you take 31 million, 57 and 53 million, you add up together and you divide it by 3, and then you will get the average value, average valuation of the company for the next 3 years or 5 years. Now, just like many other valuation, all right, just like many other things that we buy, we always like to bargain. So according to the standards of valuation by Pascal Bouvier and also University of Colorado, we apply a 25% to 35%, all right, for early growth stage at 35% and late growth stage at 25%. And then once we go IPO, we can decide to apply 25 to 35%. So it depends on the business owner, willing buyer and willing seller. All right. So other consideration. All right. Other consideration. Now, when we do business valuation, all right, we go beyond financial formulas. We just don't base. We just can't base on the assessment of the business valuation on number crunching. We also have to consider the value of the business based on its geographical location. We also have to consider the strategic value of the would-be acquirer if there are business synergies. Now, in the case of Tesco, we read in the news recently, Tesco, one of the major shareholder, which is Simon Darby, they have exited Tesco and sold to Lotus Group from Thailand. Now, why? Because they want to focus on its core business, not on the retail business, or probably they wanted to monetize and cash out. And why did Lotus Group actually acquire, all right, what we call that, Tesco business? It is because there is a business synergies, all right, that they can actually enter into this market and monetize the value that it can give in this market. So in the case of you, when you invest in a company, what is your strategic value? Can you wait 3 to 5 years? All right. And after that, the company will be able to do an IPO or maybe cash out. So these are the potential business synergies that you have to consider. All right. So and with that, I hope that I'm not long-winded. All right. And with that, thank you so much for having me today. If you have any question, please do reach out to me.